Welcome back to the show. Today, we are going to talk about something that is arguably the least sexy topic in the entire financial world. We aren't talking about AI chips, we aren't talking about crypto, and we definitely aren't talking about biotech breakthroughs.
Let me guess. We're talking about watching paint dry?
Close, we are talking about roofs, commercial roofing to be exact. And before anyone touches that skip button, I need to tell you, this specific company is putting up numbers that would make a Silicon Valley CFO blush. We are looking at a return on equity of nearly 37%.
That is massive. That is elite territory.
Exactly. We are breaking down Carlyle Company's ticker symbol CSL. It's a beast in the industrial sector. But here's the twist. Despite these incredible efficiency numbers, the stock is flashing some serious warning signs right now. We have insider selling, we have momentum flushing, and we have a valuation that looks, well, let's call it full.
It's the classic great company, wrong price dilemma.
Precisely. So today is February 14th, 2026. Happy Valentine's Day to the markets. If you are holding CSL, or if you're thinking about buying it because you saw that recent earnings beat, you need to listen to the next 15 minutes very carefully, because the easy money might have already been made.
I think that's the key phrase for today. Easy money is gone. I've been looking at the data reports generated today, and the setup here is fascinating. Carlyle has undergone this massive transformation. They used to be a conglomerate, a jack of all trades. They made brake systems, aerospace wires, you name it.
And usually conglomerates trade at a discount because they're messy.
Right? But over the last 2 years, they executed what they call Vision 2030. They sold off the medical business, they sold off the aerospace stuff, and they went pure play. They are now almost entirely focused on the building envelope.
Building envelope. That sounds fancy.
It's just industry speak for the outer shell of a building. Roofing, waterproofing, insulation, the stuff that keeps the weather out and the energy in. And this pivot worked. Their operating margins are sitting at 20.5%. For an industrial company that bends metal and pours chemicals, that is top-tier efficiency.
And that explains the ROE you mentioned earlier. 36.7%. That basically means for every dollar of shareholder capital, they are generating 37 cents of profit. That is efficiency with a capital E.
It is, and the market has rewarded them for it. The stock recently hit a high of around $435. But, and here's the big but, the engine is starting to idle.
What do you mean idling?
I'm looking at the revenue growth, or rather the lack of it. Year-over-year revenue growth is sitting at 0.33%.
0.33? That's basically flat.
It's stagnant, and that is the friction point. You have a stock trading at nearly 23 times earnings, which is a premium price, but the top-line growth has vanished. Investors are paying for a growth story, but right now, the company is just treading water on sales.
So they are becoming more efficient, squeezing more profit out of every dollar, but they aren't actually bringing in more dollars.
Exactly. And there's a lot of noise in the numbers too, because they sold off those other business units. The projected earnings per share, or EPS, for 2025 is actually showing a drop of almost 39%. Now, that's mostly accounting noise from the divestitures, but on paper, it looks messy. It scares off the algorithms and the casual investors.
Okay, so we have a high-quality business that isn't growing its revenue. But let's talk about the price action. You mentioned we are at a pivotal moment. The stock is trading around $4 or $9 right now. Why are we worried about the short term?
Because the momentum is breaking. We have a technical term for what's happening right now, a momentum flush.
Sounds painful.
It can be if you're on the wrong side of it. Look at the charts from the last 24 to 48 hours. The stock peaked at $432 after earnings, and it has just been sliding. The Relative Strength Index, or RSI, was screaming overbought. It was up over 70. Now it's dropping fast.
And that means buyers are exhausted?
It means everyone who wanted to buy has already bought. And now people are taking profits. And it's not just retail traders taking profits. This is the part that really caught my eye in the sentiment analysis. Insider selling.
Oh, I saw this. The vice chair, right?
Stephen Schwarr. On February 12th, just 2 days ago, he sold about $2.5 million worth of stock.
$2.5 million.
Now look, insiders sell for many reasons. Maybe he wants to buy a yacht, maybe he's paying taxes. But when a high-ranking executive dumps millions of dollars of stock right near an all-time high immediately after an earnings beat, that is a signal. It tells you that management thinks the stock is fully valued. They aren't betting on a massive pop next week.
It definitely puts a damper on the to the moon narrative. So we have insider selling, we have stagnant revenue, and we have technical indicators pointing down. Is there any good news here? Or are we just bashing the roof in?
No, no, don't get me wrong. This is a fantastic company. I want to be very clear. The hold recommendation confidence is at 75 values. The fundamentals provide a very hard floor. They have a free cash flow yield of 5.5%. That's a lot of cash. They are using that cash to buy back shares aggressively, about $1.3 billion in buybacks in 2025.
So they are supporting their own stock price.
Aggressively. And that's why you don't short this stock. You don't bet against it crashing because they have the cash to prop it up. But as a new buyer, you have to be patient. The report I'm looking at suggests the near-term signal for the next 1 to 5 days is a hard wait.
Wait is the hardest thing for an investor to do. Everyone wants action.
I know, but if you buy now at $409, you are catching a falling knife. The technicals on the 1 hour and 4 hour charts show a bearish crossover. The MACD, which measures momentum, is ticking down. The stock is searching for a bottom and it hasn't found it yet.
So where's the bottom? If I'm a swing trader or even a long-term investor looking for an entry, where do I set my alerts?
The data is pointing to a specific zone, $395 to $400.
Why there?
That's where the technical support levels converge. You have the 20-period moving average on the 4-hour chart and the 10-day simple moving average on the daily chart all clustering right there. It's a natural buy zone. If it drops to $395, the risk to reward ratio flips in your favor.
Okay, so we are stalking the $395 level. But what if the market gets really ugly? I mean, the broader market, the S&P 500, is also looking a bit tired.
That's the risk. CSL is an industrial stock. It's sensitive to the economy. If the S&P pulls back, CSL could drop further. The next major floor below that is the 20-day moving average at $373, or even the 50-day moving average at $349.
Ouch. $349 would be a big drop from here.
It would be about a 14% correction, and frankly, for a value investor, that would be a gift. At $350, this stock is a screaming buy. But for now, in the swing trade window of 3 to 15 days, we are watching that $395 level like a hawk.
Let's zoom out a bit. We talked about the numbers, but what about the actual business environment? You mentioned building envelope. Is that sector growing?
It is, but it's facing headwinds. Commercial real estate is complicated. Office vacancies are high. Nobody is building new office towers right now. That hurts the new construction side of their business.
But roofs leak regardless of interest rates, right?
Exactly, and that is Carlyle's moat. About 70% of their revenue comes from re-roofing, maintenance, replacement. It's non-discretionary. If you own a warehouse and the roof leaks, you fix it. You don't wait for the Federal Reserve to cut rates.
That's a great point. It's a sticky business.
Plus, there are tailwinds from green building regulations. New codes require better insulation and energy efficiency. Carlyle sells the premium stuff that helps building owners meet those codes. So, long term, the thesis is intact. Short term, the stock got ahead of itself.
It sounds like a classic case of buy the business, not the hype.
Or rather, buy the business, but wait for the sale. The stock is currently trading 14% above its 200-day moving average. That is historically stretched. Whenever CSL gets this far away from its average price, it almost always snaps back. We are in the middle of that snapback right now.
So if I'm holding the stock right now, say I bought it a year ago, I'm sitting on nice gains. Do I sell?
The recommendation for current owners is hold. You have a 5.5% cash flow yield and a management team that is buying back stock. Unless you desperately need the cash, you let the dividend and buybacks do the work. The long-term story is fine. This is purely a tactical discussion for new money or swing traders.
Okay, let's talk about the risks. What could go wrong with this wait for the dip strategy?
Two main things. First, interest rates. If rates stay higher for longer, it suppresses the entire construction sector. It makes financing renovations more expensive. Second is raw materials. Roofing membranes are made of chemicals and petroleum products. If oil prices spike, Carlyle's margins get squeezed.
And since their margins are their biggest selling point right now, that would be a problem.
Huge problem. If operating margins drop below 18%, the elite narrative falls apart. That's the warning sign to watch.
Okay, we've covered a lot of ground. We've got a high-quality company, a stagnant top line, insider selling, and a technical pullback in progress. I want to crystallize this for our listeners. If they are sitting at their trading desk right now, what is the game plan?
The game plan is patience. Do not chase this stock at $409. The probability of a successful trade here is low. You want to act like a sniper. You wait for the price to come to you.
And that price is $395.
$395 to force, that's your entry.
All right, B, bring it home. Let's do our final synthesis. I want you to break this down into a clear, actionable checklist for our listeners. Give me the sentiment, the fundamentals, and exactly when to pull the trigger.
You got it. Here's the summary for Carlyle Companies, CSL, as of February 14th, 2026.
First, news sentiment analysis. We are rating this as neutral to cautious. The earnings beat euphoria is fading, and the significant insider selling by the vice chair is a red flag that valuations are topped out for the moment.
Second, fundamental analysis. The business quality is elite. An ROE of 36.7% and 20% operating margins are best in class. However, the valuation is stretched at 22.9x earnings given the flat revenue growth. It's a great house in an expensive neighborhood.
Third, when to start investing. Do not buy today. The immediate 1 to 5 day signal is wait. You should look to enter during the swing window of 3-15 days once the momentum flush stabilizes.
Fourth, specific price point for starting. Set your limit orders in the $395 to $400,000 range. This aligns with the 4-hour moving average and daily support levels. That is where the risk-reward becomes attractive.
Fifth, when to exit to mitigate risk. If the trade goes wrong, you need to cut bait if the technical structure breaks down, specifically if the stock fails to hold the support levels we just mentioned.
Sixth, specific price point for exiting. Place your stop loss at $384. If it drops below that, the trend is broken. On the upside, if you get your entry, your take profit target is $435, retesting the recent highs.
Clear, concise, and actionable. $395 is the magic number. $384 is the bailout. B, thanks for breaking down the roof over our heads.
Anytime. Just make sure it doesn't leak.
That's it for today's episode. Keep your eyes on the charts, keep your powder dry, and we will see you in the next one.
Video title, Insider Selling Alert. Why this perfect stock is about to crash. Buy the dip level inside.